Hello students, welcome to the lecture on power and authority. After this lecture, you will be able to learn the following objectives. Understand the concept of accounting, explain functions of accounting, discuss the bookkeeping and accounting, describe the role of the accounting, describe the branches of accounting, understand basic accounting terms. Explain uses of accounting information, discuss the nature of accounting. Now let us know more about basic concept of accounting. Every profit or non-profit business entity requires a reliable internal system of accountability. A business accounting system provides this accountability by recording all activities regarding the creation of monetary inflow of sales revenue and monetary outflows of expenses resulting from operating activities. In the past, much of the work required to maintain an effective accounting system involved extensive manual effort that was tedious, aggravating, and time-consuming. Such systems relied on individual effort to continually record transactions, to add, subtract, summarize, and check for errors. Financial accounting is concerned with the recording of financial transactions and analyzing the effect of such transactions to assist in the development of business decisions. Financial accounting provides information in the form of balance sheets, income statements, and other financial statements to users affected by the performance of the business, stockholders, creditors, lenders, governmental agencies, and other outside users. Hospitality management accounting is concerned with providing specialized internal information to managers who are responsible for directing and controlling operations within the hospitality industry. Concept of accounting. Over a period of time, a number of concepts have been postulated by various bodies interested in financial statements. These concepts are incorporated by preparers in current financial statements. Prudence. Prudence is a proper caution in measuring profit and income. Where sales are made for cash, profit and income can be accounted for in full. Where sales are made on a credit basis, prudence is often exercised subjectively on grounds of experiment and is likely, in general, to lead to an understatement of profit. Consistency. This is one of the most useful concepts from the point of view of users who need to follow accounting statements through from year to year. It involves using unvarying accounting treatments from one accounting period to the next. For example, in respect of stock valuation, etc. Money measurement. Whether in historic or current terms, money is used as the unit of account to express information on a business, and from analysis of the figures, assumptions can be made by the users. As we have seen, though this concept of a common unit goes only some way towards meeting user needs, and further explanation is often needed on non-monetary requirements such as the experience of the management team, labor turnover, and social policy. Duality. Each item in a business has two accountancy aspects reflected in its accounting treatment. Debit. The debit represents an increase in the assets of the company or an expense. Credit. The credit entry represents a reduction in the cash balance to pay for the item or an increase in the level of credit taken. Matching. Often considered the same as the accruals concept, matching calls for the revenue earned in a period to be linked with related costs. This gives rise to accruals and prepayments, which account for the difference between cash flow and profit and loss information. Cost. As money is used to record items in the business accounts, each item has a cost. Accountants determine the value of an asset by reference to its purchase price, not to the value of the returns which are expected to be realized. Materiality. While preparing financial statements, accountants do not concern themselves with minor items. They attempt rather to prepare clean and sensible accounts. The concept of maternity leaves accounts open to the charge that they are not strictly accurate, but generally the advantages outweigh this shortcoming. Objectivity. Financial statements should be produced free from bias. Reports should be capable of verification, a different problem with cash forecasts. Realization. Any change in the value of an asset may not be recognized until the moment the firm realizes or disposes of that asset. Business entity concept. The affairs of the business are distinguished from the personal affairs of the owners. Thus, a separate capital account is maintained in the business books, which records the business's indebtedness to the owners. Objective of accounting. The following are the general objectives of accounting. To keeping systematic record, it is very difficult to remember all the business transactions that take place. Accounting serves this purpose of record keeping by promptly recording all the business transactions in the books of account. To ascertain the results of the operation. Accounting helps in ascertaining result. For this purpose, a business entity prepares either a trading and profit and loss account or an income and expenditure account which shows the profit or loss of the business. To ascertain the financial position of the business. This helps the businessman to know his financial strength. Financial statements are barometers of health of a business entity. To portray the liquidity position, financial reporting should provide information about how an enterprise obtains and spends cash, about its borrowing and repayment of borrowing by the enterprise to owners, and about other factors that may affect an enterprise's liquidity and solvency. To protect business properties, accounting provides up-to-date information about the various assets that the firm possesses and the liabilities the firm owes, so that nobody can claim a payment which is not due to him. Accounting records and financial statements provide financial information which help the business in making rational decisions about the steps to be taken in respect of various aspects of business. To satisfy the requirements of law, entities such as companies, societies, public trusts are compulsorily required to maintain accounts as per the law governing their operations, such as the Companies Act, Societies Act, and Public Trust Act, etc. Maintenance of accounts is also compulsory under the Sales Tax Act and Income Tax Act. Functions of accounting. The functions of accounting are given as follows. Record-keeping function. The primary function of accounting relates to recording, classification, and summary of financial transactions, journalization, posting, and preparing of final statements. These facilitate to know operating results and financial positions. Managerial function. The managerial function and decision-making programs without accounting may mislead. The day-to-day operations are compared with some predetermined standard. The variations of actual operations with predetermined standards and their analysis is possible only with the help of accounting. Legal requirement function. Auditing is compulsory in case of registered firms. Auditing is not possible without accounting. Thus, accounting becomes compulsory to comply with legal requirements. Accounting is a base, and with its help, various returns, documents, statements, etc. are prepared. Language of business. Accounting is the language of business. Various transactions are communicated through accounting. There are many parties, owners, creditors, government, employees, etc., who are interested in knowing the results of the firm, and this can be communicated only through accounting. Advantages of accounting. The following are the advantages of accounting to a business. It helps in having complete record of business transactions. It gives information about the profit or loss made by the business at the close of a year and its financial conditions. The basic function of accounting is to supply meaningful information about the financial activities of the business to the owners and the managers. It provides useful information from making economic decisions. It facilitates comparative study of the current year's profit, sales, expenses, etc. with those of the previous years. It supplies information useful in judging the management's ability to utilize enterprise resources effectively in achieving primary enterprise goals. It provides users with factual and interpretive information about transactions and other events which are useful for predicting, comparing, and evaluation of the enterprise's earning power. It helps in complying with certain legal formalities like filing of income tax and sales tax returns. If the accounts are properly maintained, the assessment of taxes is greatly facilitated. Limitations of accounting. Apart from the advantages of accounting, it has some limitations. Some of the important limitations are: focuses only on financial transactions or events while ignoring the non-monetary items, leads to wrong conclusions if the assumptions of accounting data are inaccurate, obtains biased information from the accountant if he or she is willing to make inappropriate estimations, shows fixed asset at a particular cost which would depreciate over time. Therefore, there is a significant difference between the original cost at which assets were purchased and the current replacement cost. Provide accounting information on a yearly basis only, while the information can also be required for a shorter duration. Nature of accounting. Accounting begins with the identification of financial transactions and ends with the preparation of financial statements which are useful in measuring the success and financial soundness of an organization. Accounting processes and analyzes the input data that has been collected from different business activities, processes it, and then provides this information to the interested users for various purposes. The accounting information can be useful in the following ways: provides information for taking financial decisions, fulfills the requirements of the users who rely on financial statements as their standard source of information for decision making, provides information for judging managerial efficiency to use the resources effectively for attaining the business goals and objectives, provides accurate and interpretive information regarding assumptions taken for evaluation, forecast, and assessment, provides historical information to the management to reveal past events. A brief description of the categories of information are as follows. Information related to profit. This refers to the accounting information regarding the profit earned or loss incurred by an organization. The financial statements such as trading account and profit and loss account provides such information. Information related to financial position. This includes the accounting information about the financial soundness of the business entity. The financial statements provide information about the assets and liabilities of an organization. Assets include amount of receivables, amount of cash properties, possessions, and the bank balance. Cash flow statement shows the flow of cash, both inflow and outflow, during a specified duration. It is of immense use as many decisions such as payment of liabilities, payment of dividend, and growth of the business are based on the availability of cash. Role of accounting. Accounting plays a significant role in business operations by recording, analyzing, and communicating information of financial transactions. The role of accounting has been changing with changes in the economic environment and increasing societal demands. Accounting plays different role at different times and in different fields. Now let us discuss the role of accounting. Role of language. It involves maintaining and processing the financial information required by a business entity for its management and reporting purposes. The basic function of a language is to serve as a medium of communication amongst the stakeholders of the business. Role of information system. Involves collection and communication of financial information about an enterprise to the interested parties. Role of historical records. Involves the recording of information in the form of a profit and loss account and balance sheet at the end of the financial year. This information serves as a historical record for an organization. It can be useful for various purposes such as evaluating performance, comparing the present performance of the organization with the past performance. Users of accounting information. The users of a financial statement include the present and potential investors, employees, lenders, suppliers, and other trade creditors, customers, government and their agencies, and common people. These users play an important role in the business decision making. Therefore, it is necessary to classify them into groups and provide the information required by the respective groups, who further utilizes the information to take appropriate decisions. There are two kinds of users for accounting information. Internal users. The internal users of the accounting information are the members of the organization who work within the limits of the organization, such as chief executive, the president, the vice president, line supervisors, etc., who are further categorized as owners. These people contribute capital to the business and thus are always exposed to risk. Management involves managers who have the responsibility to manage business, as in a large-scale organization, ownership and management is separate. The management has the responsibility not only to safeguard the owner's investment, but also to increase its value by managing the business efficiently to earn maximum profit. External users. The external users of the accounting information are the individuals or entities who are related to the organization in one way or the other, but they are not involved directly in the business operations of the organization. These are as follows. Banks and financial institutions provide loans to the organizations that are the main source for running the business. They assess the position of an organization from the analysis of their accounting information. Investors and potential investors refers to the external users of accounting information who bears the risks and do not have direct control over the business affairs. Creditors refers to those parties who supply goods or services on credit to an organization. Before granting credit, creditors satisfy themselves about the credit worthiness of the business. Government and its authorities make use of financial statements to compile national income accounts and other information. The government charges various taxes such as excise duty, VAT, service tax, and income tax. Society. Organizations have a responsibility towards society, and thus, both directly and indirectly, it needs to contribute for the welfare of the society by protecting the environment, increasing employment opportunities, providing educational facilities, and better infrastructure. Bookkeeping and accounting. Accounting as an information system is the process of identifying, measuring, and communicating the economic information of an organization to its users who need the information for decision making. It identifies transactions and events of a specific entity. A transaction is an exchange in which each participant receives or sacrifices value. Definition of accounting. American Institute of Certified Public Accountants, AICPA, which defines accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. Importance of accounting. Owners. The owners provide funds or capital for the organization. Owners, being businessmen, always keep an eye on the returns from the investment. Comparing the accounts of various years helps in getting good pieces of information. Management. Management is interested in financial accounting to find whether the business carried on is profitable or not. The financial accounting is the eyes and ears of management and facilitates in drawing future course of action, further expansion, etc. Creditors. Creditors are the persons who supply goods on credit, or bankers or lenders of money. It is usual that these groups are interested to know the financial soundness before granting credit. Employees. Payment of bonus depends upon the size of profit earned by the firm. The more important point is that the workers expect regular incomes for the bread. The demand for wage rise, bonus, better working conditions, etc. depend upon the profitability of the firm and in turn depends upon financial position. Investors. The prospective investors who want to invest their money in a firm, of course, wish to see the progress and prosperity of the firm before investing their amount. Government. The state and central governments are interested in the financial statements to know the earnings for the purpose of taxation. Consumers. These groups are interested in getting the goods at reduced price. Research scholars. To make a study into the financial operations of a particular firm, the research scholar needs detailed accounting information relating to purchases, sales, expenses, cost of materials used, and all other information of firm. Branches of accounting. Accounting is a very old science which aims at keeping records of various transactions. Accounting can be broadly divided into three categories. Financial accounting. Financial accounting is defined as art and science of classifying, analyzing, and recording business transactions in a systematic manner in order to prepare a summary at the end of the year to find out the results of the concerned accounting year. The following terms will give more clarity. Business transactions. A transaction means an activity. A business transaction means any activity which creates some kind of legal relationship. Classification of transaction. A transaction can be classified as cash transaction and credit transaction. Similarly, transactions of receiving income and payment of expenditure can be segregated. Even in case of expenditure, transactions involving revenue expenditure and capital expenditure can be segregated. Recording of transactions. The recording of the transaction is known as entry. There are well-defined rules for recording various transactions in books of accounts. As per the rules of financial accounting, each and every transaction is recorded at two places, and hence it is called as double entry system of accounting. Summary of transactions. After recording all transactions, it is essential to prepare a summary of them so as to draw meaningful conclusions. In order to find out the profit loss of a particular year, the process of preparing the summary is extremely important. Cost accounting. It is a type of accounting process that aims to capture a company's costs of production by assessing the input costs of each step of production as well as fixed costs such as depreciation of capital equipment. Cost accounting will first measure and record these costs individually, then compare input results to output or actual results to aid company management in measuring financial performance. It is often used within a company to aid in decision making. Cost accounting can be most beneficial as a tool for management in budgeting and in setting up cost control programs. Management accounting. The main purpose of management accounting is to provide information to the management team at all levels within the organization for the following purposes: formulating the policies, strategic planning, planning the activities of the organization, corporate planning, controlling the activities of the organization, decision making, long-term and tactical, performance appraisal at strategic and operational level. A management accounting or cost statement provides information to allow managers to plan, control, and organize the activities of the business. The purpose of a costing or management accounting information system is to provide information about product costing to be used in financial statements, controlling and organizing, to provide information for planning. Basic accounting terms. Trading items. Trade means purchase and sale of goods and services. All goods or items which are purchased by the businessmen in order to sell them, thereby earn profit, are called trading items. Non-trading items. Items which are purchased by the business concern in order to use them are called as non-trading items. These items are not meant for sale. Assets. Assets are purchased for use or for future benefits and are broadly classified into two categories. Current assets. Current assets are those assets which are held for short time, generally a year's time only. Examples: cash in hand or cash in bank. Non-current assets are those assets which are acquired for long-term use in the business. These assets increase the profit. Examples of other assets are land, building and machinery. Liabilities. Any amount which the firm owes to the proprietors and outsiders is termed as liability for the business unit. Hence, liabilities are the obligations or debts payable by the business unit in future. Liabilities have been classified as external liabilities. External liabilities are those liabilities which the business owes to the outsiders for goods purchased on credit, for expense or for loans taken. Internal liabilities. Internal liabilities are those liabilities which business owes to the owners or proprietors. It is the proprietor's claim against the assets of the business. Revenue. Revenue refers to the inflow of money or other assets that result from the sale of goods or services or from the use of money. It is the amount realized or receivable from the sale of goods. Revenue should not be confused with income. Expense. All costs incurred in earning revenue are called as expense. It refers to the cost which is incurred in acquiring an asset or service. Example: transportation cost incurred in transferring raw materials in the factory. Expense and expenditure. Expenditure is generally the amount spent for the purchase of assets. It increases the profit earning capacity of the business. For example, furniture purchased, machines purchased, etc. Expense, on the other hand, is an amount to earn revenue. Some examples of expenses are the payments made for rent, wages, salaries, etc. Now in the end, let us summarize what we have learnt in this lecture. Summary. Accounting as an information system is the process of identifying, measuring and communicating the economic information of an organization to its users for decision making. All trading and non-trading items purchased by a business concern are of value. These items are purchased for use or for future benefits. The purpose of management accounting in the organization is to support competitive decision making by collecting, processing and communicating information that helps management plan, control and evaluate business processes and company strategy. The primary function of accounting relates to recording, classification and summary of financial transactions, journalization, posting and preparation of final statements. These facilitate to know operating results and financial positions. Financial accounting is the field of accountancy concerned with the preparation of financial statements for decision makers such as stockholders, suppliers, banks, employees, government agencies, owners and other stakeholders.